Hello, welcome to the next in our series of videos on IFRS9 for corporates. I'm Sandra Thompson. I lead our global accounting technical group for financial instruments, and I'm here today with Geert Wognum. He's on secondment to us from our Dutch firm, and he's been helping our clients as they implement IFRS9. Today we're going to carry on talking about hedge accounting, and we're going to particularly look at some issues that affect companies that hedge forecast transactions, forecast purchases or sales. We're going to cover three issues. The first is basis adjustment. The second is the need to discount or take into account the time value of money. And thirdly, we're going to look at hedge documentation. So let's start with basis adjustment. Geert, what do we mean by basis adjustment? That's a nice accounting term.
Yes, it is. And a basis adjustment doesn't apply for everyone, because a basis adjustment only applies when you're hedging a forecast purchase of a non-financial item. So, for example, when you're hedging inventory or PP&E items. Now, under IFRS9, of course, the effective portions of such a hedge is deferred in OCI. But when the inventory or the PPE item is recognized, IFRS9 gives you a choice. You can either leave the adjustment in the hedge reserve, or you can adjust the initial carrying value of the inventory and the PPE item. And that adjustment is called the basis adjustment. Now that choice will go away. So under IFRS9, you have to do that choice every time you recognize the inventory PPE which was hedged.
So you're saying that now when you hedge PP&E, for example, or inventory, when you actually buy the inventory or the PP&E, that initial cost will have to include the hedging gain or loss.
Correct.
Okay. And will there be any difference? Will the income statement be affected?
No, the income statement is exactly the same, because under IFRS9, even when you sold the inventory or when the PP&E item was amortized, you had to amortize the effect deferred in equity. So the income statement will be exactly the same, and it's only the presentation in the balance sheet which will be different. Now, Sandra, there has been some discussion on how the transition with this base adjustment will actually work. Can you explain?
Yes, so generally IFRS9's hedge accounting requirements are prospective, so they only apply to new transactions. So for example, if at the date you transition to IFRS9, probably the 1st of January 2018, you have a derivative that's outstanding and it's hedging a forecast purchase. When that purchase happens, that will be after transition, perhaps sometime later in 2018 or 2019. At that point, you will need to do the basis adjustment, and you will need to adjust that initial carrying amount of the inventory or PP&E. There's a bit of an open question about what you do if, as at the date of adoption, you have inventory or PP&E actually sitting on your balance sheet that has been hedged in the past. Do you have to update that for basis adjustment if you didn't previously? Now, we think the standard's not entirely clear, and actually you could probably do either. So if you have that outstanding inventory that has been hedged but not yet been expensed through the income statement as cost of sales, you can choose either to update the carrying value for the basis adjustment or to leave that unadjusted and just recycle the hedging gain or loss separately when the inventory is sold. So we're now going to move on to our second topic for today. Here, I'm aware that IFRS9 requires companies to take into account the time value of money when measuring effectiveness. What does that mean? What impact will it have?
Yeah, you're right. The standard requires the time value to be taken into account. Now, when does that apply? It's best to talk about an example. So if, let's say you're hedging with a foreign currency forward contract and you're hedging forecast purchases or sales. Time value of money is already taken into account in the measurement of the derivative, because the derivative is measured on a net present value basis. The standard says that if you're hedging spot, that time value needs to be considered as well. So changes in spot will be changes of the future cash flow due to changes in spot rate. So it's actually a cash flow in the future. And the standard therefore requires that cash flow to be discounted as well, to be more aligned between the hedged item and hedging instrument.
And Geert, do you think this will have much practical impact? And many of the companies I'm familiar with try to match the maturity of their derivative to the forecast timing of their sale or purchase.
Well, in many cases it won't be. As you say, if you match the timing perfectly, and also if the hedge horizon isn't very far out, then the discounting won't be a big effect. So it will be a bigger effect if there's a bigger mismatch in timing.
So for example, if you had a company that used, let's say, a 5-year debt instrument to hedge a forecast sale in a year, then it could be big, I'm assuming.
Yes, because the debt instrument, the foreign currency component, is measured in line with IAS21, while the hedged item now discounting has to be included. Well, under IAS39 we would have done undiscounted spot.
And then finally, our third topic today, hedge documentation. Now I know we've touched on this in a couple of other videos, but here, can you just outline exactly what's changed?
Yes, so if you look at the slide, the criteria for the hedge documentation in IFRS 9 are quite similar to IAS 39. So many of the items, such as what is the hedge item, what is the hedging instruments, are the same. There are also differences. So IFRS 9 now requires you to explain how the hedge objective is in line with the risk management strategy. And also you need to be explicit in what sources of ineffectiveness exist in the hedge relationship and how the hedge ratio was determined. And in the sources of ineffectiveness, you also need to explain that the hedge relationship isn't dominated by credit risk. So at a minimum, each hedge document should be updated for these items.
I presume that's the case, even if your hedge accounting itself is unchanged, the hedge documentation still needs to be updated?
That's correct.
Very practical tip, thank you. So just to recap, we've looked at 3 issues today that will affect companies that hedge, forecast, purchase or sales. The first is basis adjustment. So if you are hedging a forecast purchase of, say, inventory or PP&E, and under IFRS 9, when you buy that inventory or PP&E, you'll need to include the hedging gain or loss in the initial carrying amount. The second thing we looked at was the requirements to take into account the time value of money, and particularly if there are quite significant differences between the hedge transaction and the instrument you're using to hedge with, that could have a material impact. And then finally, we looked at hedge documentation, and particularly we noticed that even if nothing else changes and all your hedge accounting is the same, you will still need to update your hedge documentation, and that needs to be done when you first adopt the standard for most companies by the 1st of January 2018. Thank you very much for listening, and I hope you'll join us next time. Bye-bye.